You're about to join Jerry Parker, Moritz Seibert, and Niels Kostrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Hi everyone, and welcome to the first edition of the Systematic Investor series, where each week we discuss and debate what is going on in the world of rule-based investing right now. My name is Niels Kostrup-Larsen, and I'm excited to welcome my co-hosts Jerry Parker and Moritz Seibert. So we've been talking about how we should kick off this brand new podcast series, and I think we all felt that it was a good idea to talk a little bit about who we are and why we're doing this, and also what our listeners should expect when they come and listen to us each week. So why don't we just jump right into it and start maybe with you, Jerry. You probably don't really need any introduction among our listeners, but why don't you tell us a little bit about your background?
Thank you, Niels. I've been involved in trend following since 1983, and I liked trend following before 1983, and I was so happy and thankful that when I met experts in trading and rules-based trading and trend following, they told me that they believed in trend following as well. So it was kind of a very, very nice coincidence. And so I had great mentors, Richard Dennis, Bill Eckhart, back in the 80s, and the famous Turtle program. And then that launched my career.
Yeah. Sure. Absolutely. What about you, Moritz? How did you end up in this wonderful world of systematic investing?
Well, long story. I currently work for Munich Re and design and implement trend following strategies for them, but really started trading in a systematic way around the year 2000. So during the tech bubble or the end of the tech bubble, it didn't really work out that well for me. And I decided that I'll just quit discretionary trading and make it rules-based. And it started with trend following and it never stopped. So I'm a big fan and I'm doing it ever since.
Sure. Fantastic. Well, for my part, I actually started as I guess you could call it discretionary trade. I was certainly didn't have any rules back then in the 80s when I started trading government bonds back in Denmark. But coincidentally and happening at the same time as I started a small wealth management company, I ran into this magazine called Managed Account Reports that, listed a lot of the returns of CTAs, and pretty sure you, Jerry, was in there back then, and sort of starting researching what was really behind these quite incredible returns, pretty much got sold on the idea of systematic trading. And so for the past 28 years, that's what I've been doing. So my day job, as most people who listen to the podcast know, I work for another legend, which is Dunn Capital, and then launched this podcast back in 2014, and it's been a great privilege really to have conversations with some of the absolute best systematic investors in the world, and also to be able to share this access with so many listeners around the world. So that's pretty much my story and how I got to where we are today. So now that we've got the formal introductions over, let's talk about why we're doing it. And I think and maybe I'll just kick it off, and then you can add your opinions. But I mean, I think for me, there are a lot of good podcasts right now on the topic of investing, and I think a lot of them are like I started out. They're interview based, and you go through people's history and their trading and very interesting stuff, and you can learn a lot from it. But I do think there is something lacking, and that is, I think there is not really a current sort of a podcast where you debate current topics, what's going on right now. There is in the world of news and what's happening in the financial markets right now, but not really from the, looking through the lens of a systematic trader. How we view the world? What do we see? What's changing in our, in our systems, opinions, and so on and so forth. So for me, that's really, one of the the big reasons why I think this is an interesting new weekly series where we can bring a different perspective to the world of podcasting, but also to the investors around the world who want to expand more on their knowledge and maybe also where they don't get so much insight intra-month, but where they only see the monthly reports from the various managers. So that's, and of course I love talking to you guys. So that, why not put that on a podcast platform and share our conversations with them every week. So that's really my motivation. What about you, Moritz? And by the way, Moritz, feel free to speak louder.
Okay, I'll try that. I think for me, it's just the fun. I mean, it's great talking with two friends about trend following. I enjoy that, and I think repeating over and over again that people should stay diversified in their portfolios, follow their trading rules, don't give up. Especially with respect to trend following, you'll have those drawdowns. Sometimes they can be very painful. Those are not the times to give up. Stick with it, and just I hope that we'll get some education across and add value to the world of systematic trading.
Sure. What about you, Jerry?
I'm always interested in fun, so I do think it's fun. It's fun talking to you guys and learning. I think that the more we discuss these issues, I'll come up with some insight, hopefully, and improve my understanding. I feel like I understood the parameters and going long and going short, but the deeper meaning of what we do, I'm always uncovering important insights, at least for me. Also, I like the idea of encouraging each other and encouraging others, because it is a rules-based is the first part, but then actually following those rules is really difficult. And so the more we can encourage each other and encourage other people and spread the message, that's really something I enjoy doing.
Yeah, I think that's a great point, because it in some ways it can be kind of a lonely industry, even though we're surrounded by lots of peers. But you're absolutely right. I mean, and so mentorship, like you, Jerry, obviously you're the best example of that. How important mentorship in this business can be, and not only if you want to become a manager yourself. I actually think that investors investing in these strategies benefit from mentorship as well, because we just don't want to see them disappear out of the industry at the wrong time, and neither do we want them to get into the industry or this investment class at the wrong time. So I think those are great motivations. Now, despite us wanting to, we want this to be a pretty raw conversation, like if we were just meeting up in the local Starbucks and sat around a table, and we want to invite people to come along and listen to this. But we did talk about prior to this recording that we wanted to have a little bit of a structure, so people have an idea of what are the things we're going to be talking about this week. And I don't know, Moritz, if you want to kick that off a little bit in terms of some of the topics that the people should expect to hear about and on a weekly basis, so to speak.
Yeah, so what we'd like to do is review the weekend trend following, or maybe the month in trend following, if there has been like meaningful position changes, meaningful events, interesting events that are worth speaking about. But speaking about that, so for instance, last week has been relatively quiet in terms of trend following trading, at least as far as our system is concerned. No meaningful changes in positions, still the same positions on that we had the week prior. We had a quiet start to the month. This past week has been up a bit. So fairly stable. So to the extent that you look at the computer and you say like, well, why is nothing happening? But really, we just didn't get any signals. But then I think in addition to just speaking about trend following trading performance in the rearview mirror, like with respect to the past week, we'd like to touch on a few topics that we think are of interest, like, does trend following work on single stocks? Is trend following beta? Fee structures? Some old wisdom.
Yeah, no, you're right. I mean, there's so many things we that comes up on a regular basis that investors are interested in. So you're absolutely right that we have a long list of topics that we certainly want to go through over time. Absolutely. I want to come back to maybe a little bit about this week in trend or what's going right now, if I may, but. We also had something else that involves you, Jerry, that we wanted to touch on every week. I called it Jerry's top tweets. You're active on Twitter, and you've got some great articles that you share and views. So that was another thing we wanted to integrate in this weekly conversation.
That's right. I try to tell myself to get off Twitter, and I can't quite do it. So. Thanks to people like you encourage me to keep going, and I do, but I sometimes regret it. Yeah, I like to read these articles throughout the day and view them through a trend following lens. I mean, I think for some people, they could read the same article and say that has nothing to do with trend following or rules-based or diversification. And I'm like, oh, wait, just a second.
Yeah.
So I like, the trend following worldview and apply that to buy and hold, traditional, passive, the stuff that we're bombarded with. So I think that maybe it's a stretch sometimes, but I believe I'm a live on planet trend following, and it takes someone like me to sort of try to figure out from a trend following point of view, we may not really agree with that. There's another way of looking at things. And that's what I really enjoy.
Yeah. I think it's interesting. I definitely see. I think by the way, Twitter seems to have started this new thing that's called "In Case You Missed It." So every morning when I get up, Jerry, I get all your tweets in kind of one go, which is pretty cool actually. Nice way to start the day. But I think it also tells me something else, and I think it goes for all of us actually. But I think it's important maybe to highlight, and that is. I feel we're all still students. I mean, people might look at Jerry and say, well, he's been doing this for 30 years. He's, the most successful turtle in the world. But when you speak, Jerry, you keep on reiterating that you're still learning. And I certainly feel the same. I certainly have a strong feeling that Moritz, you're also, and I think that's important. I mean, this is not something that you learn once and then you just go on and apply it forever. I mean, it is a learning process on both the psychological level and on the technical levels and so on and so forth.
It's a journey, and it's a very enjoyable journey for me.
That's a great thing. By the way, there was this song by what's her name, Hannah Montana, I think. Where it talks about, she sings about the journey being more important than the destination, which is pretty true actually. That you have to enjoy the journey. Yeah. So I think we all.
And look, I mean, things keep changing, markets change, they evolve, and it's not always easy to be a trend following trader, right? So you get into those periods where it's really tough to hang on sometimes. So that's the psychological part of that, right? And those are the times when you can learn a lot about trading, but also about yourself. Like, how do you react to losses? And before you know it, all of a sudden your system turns around and you're making money hand over fist. And then it feels like, oh, well, that really wasn't that bad. But actually, when you're living through it, it's a completely different type of thing. And this is, at least as far as I'm concerned, I mean, that has been a multi-year process to come to terms with how that works. But when you're following that process and you're following the rules, you can also enjoy the benefits. And I think that is really important to always have that front of your mind, remind yourself about that, and get on with it.
Yeah, no, I mean, for my part, I still think it can be difficult, not least because you're also, I mean, I feel a responsibility to the investors that we have. So it's never nice to go through a time where they don't feel, completely happy, and especially if other things in their portfolio is not, doing so well. It's, you take certain, you take a responsibility, and even though we preach the fact that, we should take out our emotions, we do that in the investment process, but it doesn't mean that we're not human beings, and we don't, we don't feel the pain.
No doubt.
What about you, Jerry? How do you feel after all these years on your side?
There's definitely a lot of pain, and it's coming from criticism and clients in the markets, and the competitive nature, and not wanting to lose at anything.
Yeah.
When I first started trading,
Yeah.
I worked for a really smart person, and he gave us $1 million to manage. And he said, just do the right things and don't worry about it. If you're doing the right trades, like I taught you. Now, when you get into the real world, that's not what people say. I don't care what it takes. You can cheat, you can do a counter trade, just make me money. And so I realized that we lived in a very pretend world, a very nice one, at least for the first 4 years of trading. We were taken care of and cloistered in a way that allowed us to maybe withstand some of the constant, criticism or doubt. Clients do make you doubt.
Yeah. I mean, there's no doubt, at least for me, when I look at your journey, Jerry, and obviously, as many people probably know, I also worked for you back in the 90s, and there's no doubt when I look at that journey that you probably, I mean, you had the best entree to this world that you can imagine. I mean, someone that would take you under, his wings and shield you from some of the things that you end up facing. A little bit like childhood, right? I mean, so you get a chance to learn to walk and run before you have to in the real world, and that's a great start. And unfortunately, those opportunities don't really exist anymore, as far as I can tell.
That's right. It's sort of like giving someone a set of rules and saying, "Go be a Marine," go be an officer. No, you can't just give them the rules. They have to live it and breathe it and experience it. And so we had so much more than some rules that were going to change, and parameters that had to change and evolve. So that experience doesn't really get talked about a great deal. What were you guys doing each day? What was Rich saying each day? What happened when you lost 35% after the first 6 months? It's the focus on the rules and how do you trade. The experience gave us a big leg up.
Yeah, no, definitely. We also wanted to do one other thing, and maybe we go back to some of these points we just talked about, but we did want to do one more thing every week if we can. And that maybe is to take a question or two from the listeners. So if you have a question you want to pose for us to talk about, and hopefully we can come up with a. So maybe it's the question and attempted answers kind of section. Feel free to send it to info@toptradersunplugged.com. And we'll see what comes up. Actually, I did get a question this week, interestingly enough, which I'm happy to pose. But I wanted to, maybe because it's the first edition and maybe it'll be a little bit longer than usual, but I do want to go back to maybe give people a little bit of a feel for this. Moritz, you talked a little bit about your portfolio and it hadn't moved a lot this week. It's improved, but you said it was a quiet week. What are the themes that you see in your trend following approach right now when you look at the portfolio?
So what's happened in the past weeks is we've made a lot of money from being short precious metals. That has stopped. So, being short gold, being short silver, those have been great trades. We're still in those trades, but the downside movement has stopped. We've also had a good run in some of the energy markets, and that just is flatlining for the time being. flatlining, not to the point that, it produces new signals or gets us out of the trades or, results in a meaningful change of position size. Just stopped moving in the past couple of days. So that's what I meant with quiet. And as you know, we can come into the office on Monday and that changes in a heartbeat.
Sure. Have you been busy this week, Jerry?
No, not busy. Not busy trade-wise. We're making money in the same markets.
No.
I would just say from my point of view, it's dominating the markets, or the stocks, of course. We trade the single stocks, trend following the single stocks with not the indices. And so some of those stocks are in nice uptrends, the tech stocks in particular, Nike. Then I think overall there's too many shorts. The shorts are not that great. Historically, they're great for diversification mostly. But the mega trades that we need are going to be long precious metals, long soybeans and corn. So I'm a little negative, and I didn't even realize how much that we had a good month in August due to all these short trades, because I don't follow performance daily, and I was just not being that confident. I didn't want to go short gold, I wanted to go long gold. So when I look up, we made money. So there's just been a preponderance of these short trades, and typically prefer longs. So, but we'll go with the trend.
Yeah.
Very good point on that.
I
actually,
mean, that's
just looking at the number here. I mean, our portfolio is about 45% short at that point in time, which is a very high number. Even compared to history, and metals short. In the currencies, it's pretty much one way: long the dollar, short all the others. So it does have a lot of short positions, and I agree with Jerry that the longs do work better. So if we had more longs and stronger uptrends, that would be a good thing.
So let me throw a question to you guys. A statistic that I came across many years ago. Someone was running a pretty simple, straightforward 100-day breakout type system, and then the data that came out when we look back many years in terms of performance, about 90% of the performance came from long-sided trades. So for those who may not know about this, I wanted to ask you, just out of curiosity, what do you attribute to that? Because clearly this is one of the things that I think you're referring to, Jerry, that you like the long-sided trades rather than the short trades. Is that related to the statistics that I just mentioned?
Totally related to the statistics. I don't think it's appropriate to segregate the trades in that way. I'm going to trade the longs and shorts differently. That's obviously not what we do or should do, or even I think look at them that way. So right out of the box, I violated one of the big trend following principles. It's just hard to ignore. But we've had great short trades before over the years, but the numbers, it's better if they're long, but I think it's best.
Why do you think that? Why is that? Why is it so much easier to make money on the long side?
I mean, unlimited upside, unlimited potential. The longs, there's some trades in the database that go 100 ATRs, 200 ATRs, and a lot of the shorts, if they went to zero, they wouldn't make 100 ATR. So it's just within the. Although I do think that it's technically or statistically possible for that to change over time. It's one of the great things about trend following. Things that have never happened before, we're ready. We crushed it because all we did was follow the trend and close our ears and close our eyes and try not to think too much more than that. Just let's go with the trend and maybe look down initially, but trend followers are the only ones who are going to stay long interest rates as they approach zero and they keep going, or short crude at 90 and hold on to it when it goes down to 20. So there's benefit.
Yeah. I agree. I'd love to hear your views, Moritz, but I mean, I agree completely with that point, Jerry, but in my own mind, at least, maybe because I started out, as a sort of, from the discretionary side, I guess you could say, or from a trader side, is I've always felt, rightly or wrongly, that short-sided trades were harder for us to capture because lows are often made quite quickly, but it can take a long, like we saw in stocks in February of whenever it was, 2009 or March 2009. It was like one day and then off we went to the races, and 10 years later we're still going up. But long-sided trades or top seems to be forming over several weeks, several months. So I always felt that our systems would have a better chance of getting out and not give back too much of the profits in some kind of quick reversal. Does any one of you think the same?
Yeah.
Or is it just me?
I think in equities, sure. Downside movements, they are quicker, more erratic. There's more movement there. The trends on the upside, they tend to be a bit more stable, longer term. So in equities, yes, I mean, trading those from the long side, that works better. But then, don't forget about, bonds. I mean, we all have a large allocation to bonds, and, obviously that has been a long trade for years and years and years and years and years. So, saying the shorts don't work there, I think that's a stretch. And we also shouldn't forget that, we all say it's diversification. We're trading across many, many different markets and sectors, but also trading long and short. That is a lot of diversification, right? So having longs and shorts in the portfolio active at the same point in time, that is important. So the short trades, they do deserve credit where it's due. It's just that for whatever reason, also when you look at the energies, the commodities, the shorts just don't work that well as the longs.
Yeah. No, that's all very valid. All very valid points. I mean, it's, going back to, and I think you, Jerry, said it's been incredibly quiet on your side in terms of trading activity before we started our conversation today. But also when I look at it more objectively, I've got this trend barometer that just monitors, what's going on from a momentum point of view. It's not really a trading system, but it is a good proxy for what is going on in our industry. And I'm just looking at it right now, and it's like, out of 11 markets or maybe 15 markets in total out of 44 that is in some kind of trend or defined by this measure, only 2 of them are uptrends, which is I think it's the Swiss franc and NASDAQ, but all the other markets that indicates a trend is to the downside, and most of them actually in the commodity space, which is interesting as well. And if you look at the Bloomberg Commodity Index, I mean, that's not doing so well. So it's an interesting time. I think a lot of investors, I'm not sure they can really participate, that they do participate in these big down moves in commodities unless they really trade the index. It's a harder trade to get into, I think, for normal investors. So it's part of the diversification, I guess.
One thing I'd like to...
So what is going on your side other than that, Jerry? Anything in particular?
One thing I'd like to bring up as a topic, maybe for a future podcast, would be, I think that there's evidence that a long bond trade is actually a short trade. So I think that's kind of an interesting thing to look at. I think we're actually short interest rates. So that's maybe something for another day. But I've never looked at these patterns like that. I've just run the systems, looked at the back test and said, oh, the shorts are not that great. But I've never had a desire to sort of look at patterns and say, oh, the shorts behave differently. I hear that, and I'm sure that you're right, but I just never. And I guess, but I see these crashes happening in longs and shorts. I think this is one of the things over the past 10 or 15 years that's distressing about trend following is it's frequently a crash, a long trade, and the volatility picks up, and it looks like a lot of people are trying to exit at the same time. We had it this week in the emissions contract, and that was a pretty violent sell-off, but pretty much similar to cotton and some of the other cocoa,
right,
and some of the other markets that it looks like the amount of trading and exiting and selling that happens is too much for the market to handle. But of course, we've seen it in interest rates and in stocks as well. So I think this is sort of a plague on trend following. We're going to have trends. Trend following may not work one of these days, but it won't mean we won't have trends. We'll have massive trends the last 2 or 3 years. Yeah. The problem these days is what are you going to do when it looks like you're going to get back a year's worth of profit in a week? So that's what we need to be concerned about. The trend followers possibly are creating their own demise.
Well, I think that's true, and you hear that. I come across that a lot over here from investors and potential investors when they criticize the returns of recent returns of trend following. But of course, the company I work for, we've actually had better returns in the last 5.5 years than we've had in our the previous 40 years. So I don't recognize the fact that trend following is becoming worse than it used to be. I think it requires maybe different methodologies, evolving your systems, your methods, et cetera. I don't think trend following is going away, but clearly when there are more people maybe using the same, maybe more simplified approaches, and maybe a lot of the end investors now think they can do it themselves, or they don't want to pay the fees, or the banks say, oh, we can do momentum and we'll do it for you for 10 basis points. So they use usually very simple, in my opinion at least, they use simple approaches to capture this factor. And therefore they probably will look alike, and therefore they probably will be exiting and entering more or less at the same time. And that can cause some disturbances. But I think if you come up with better exits in particular, I'm very focused. I think exits are really, really important in what we do when it comes to determining performance, because I think we all spot a trend when it begins more or less at the same time, whether we use breakouts or time series momentum, whatever it might be. But I think the exits is where we can really differentiate ourselves, and yeah. So that's how I see that. But I hear that a lot, Jerry. That's for sure. Would you be up for? By the way, Jerry, did you have a great tweet or two this week that you wanted to share? Or I know we didn't maybe prepare anything, but that's the great thing about this podcast series. We're not going to be that prepared, actually. We're going to just talk and see what happens.
Yeah, sure. 95% of the time, I tweet an article and I pull some copy paste the best part. And of course, it suits my opinions. And but this week, I liked this one article, and I had my own rare comment that I included in the tweet, and it went something like this: that I read a lot of articles, of course, that talk about adding diversification to a portfolio. And you mentioned earlier commodities, right? And it's difficult for this. When I see this analysis, it's difficult for the commodity or basket to be included in a portfolio, because the assumption is it's going to be a buy and hold. So what the trend followers, CTA, diversified trend followers, do is they can add markets to a portfolio that are not good as buy and hold. And where traditionally the analysis is, how does gold do? Well, I'm talking buy and hold, of course. Well, it may not do that great. So you may say, well, there's a real lost opportunity here if I invest in some gold or corn or soybeans or commodities or crude, and I prefer the 60-40 then. And what we're seeing is that that's true. If you want to add some of these crazy commodities and foreign exchange into your portfolio, you must use trend following in order to expect it to add diversification, plus actually add to performance. And I think, and then of course you mentioned shorts, and that's a great secret that people should not shy away from shorts, regardless of what I said 5 minutes ago. They add diversification. They can make money, and then that's pretty much totally you're going to get that totally from CTAs and almost nowhere else. The short corn, short coffee, short soybeans that we have on now, and so CTAs can safely and profitably put some of these other markets in a portfolio, but it must be with the trend following. It's frustrating to keep, reading articles about diversification, and the one mindset is, well, it has to be buy and hold, right? And I'm like, no, it's not buy and hold. It's trend following rehabilitates markets that historically haven't made money, and magically they become profitable.
Yeah. So and also in other words, it's not just the market that adds diversification; it's the approach that adds, the way you trade those markets that adds diversification. It's funny you say that. I could be completely wrong here, but I seem to have seen an analysis by someone who studies the markets and have done for many, many years, and I'm pretty sure he was talking about commodities generally having a 35-year cycle, a little bit like the interest rate cycle in terms of length. But the majority of the time, I think something like 2/3 of the time, commodities spend the time going down. And only 1/3 of that full cycle, the market goes up. So, if that's the case, and I actually don't think it's completely wrong when you look at the long-term charts, then clearly, the buy and hold in commodities is a pretty painful exercise. And just look, as I mentioned earlier, I was just looking at the Bloomberg Commodity Index. I mean, that's gone down for quite a while and quite a lot. So, if you didn't do the trade on the short side as well, it wouldn't have been a fun asset class to have in your portfolio.
Exactly. We're all fooled because it's so easy with stocks. They just keep going up all the time. And we've had so much success with that. And bonds are great diversifier as well. And so that's what we think. That's how markets behave. Yeah. A good market, a good investment, you buy it, you hold on to it, and it goes up. And so these other markets are perfectly great markets that just don't have, the equity premium or whatever fundamental people call it. And now I might be a little skeptical that the last 100 years the next 100 years will be as good as the previous 100 years. But even given that, that's fine. I can deal with that. But please let me add some real diversification to your portfolio with some long, short commodities, FX, using a trend following system.
Yeah. No, indeed. Any thoughts on your side, Moritz? Otherwise, I'm going to throw in that question we had from the listener.
I agree with that, but I don't think any of those markets are buy and hold markets. I mean, just looking at the charts, if you look at natural gas, lean hogs, live cattle, those are not buy and hold markets. They're trading markets, long and short. And I don't know about those cycles, like, those 30-year, 35-year cycles. I have no opinion on that, whether they exist or don't exist. But just looking at the charts, it's very clear that you want to trade those markets. And then you have those studies that say, well, adding commodities to a diversified equity portfolio diversifies it even more, and it gives us an inflation hedge. Okay, fine. But it does give you an even better hedge if you apply a trend following trading method to those. And also, I think the same goes for equities. I mean, you have the equity risk premium, and buying and holding equities produces a positive annual return. Okay, that's great. But, why don't you start with, say, trend following on equities, and then if you feel like it, to add buy and hold to it, then add buy and hold to it to get that equity risk premium. But most people get it the other way around. They say, I'll start with buy and hold equities. That's 70% of my portfolio, maybe 80% of my portfolio, whatever the number is. And then I add a trading strategy on top, like trend following. And I do it exactly the other way around. You get better results.
Yeah, definitely. Now, before I get to the question from our listener, I think another thing could be, if I remember, I'm sure, to just for this, since it's a weekly thing we do and think we want to bring people closer, I think I want to every week try and just give people a sense of where these indices are. And by the way, with performance It's going to be close of business Thursday because the indices don't get updated on Friday. So this week, I know Friday was a great week for most strategies in our space. So these numbers will probably be definitely on the low side. But anyways, this week so far, or I should say month to date so far, B top 50 is down 0.15 and down 2.8 for the year. The SocGen CTA index is down 1.02% for the month and down 3.83 for the year. The SocGen Trend Index, which is probably closest to what we do, down 1.16 for the month. 61 for the month and down 3.82 for the year. And then the short-term traders index is down 0.73 for the month so far as of Thursday and down 0.18 for the year 2018. But let me get to this question that I've been talking about. So this is from Bruno. I'll just say his first name because I don't know if I've got permission to say his full name. But Bruno sent me this question, and here goes. Although not all managers want to have an AUM in the billions, I would love to know what differentiates a fund that has achieved billions in AUM from a fund that is looking to get to that level but never did, even though they might have similar performance. Why some make it to the big leagues and why some don't? Is there an art to raising money aside from performance, such as networking, or who you know, or who you know, kind of thing? What are the steps an up-and-coming manager needs to take towards raising capital? That was the question from Bruno. Who wants to go first?
Well, I actually tweeted about that subject this week. I'm an article, and the
cool. All right.
The title of the article from CTA Intelligence magazine is "Investors Value Marketing Message, Not Performance." And my quote was, managers should have a clear, concise message instead of touting their track record. The marketing campaign goal is not to raise capital, but to raise actionable conviction. I think just, historically, I've had some experience on raising money and facing redemptions. Obviously, it's people dealing with people and competence and your ability to inspire confidence in clients, plus the performance. I think performance is probably more important, especially managers who don't have a lot of AUM probably think their performance is just as good as everyone else's, but probably statistically it's probably not. But definitely, especially in this day and age, I think being seen as a institutional quality organization with lots of people and internal controls and the firm. And I think a lot of the small organizations and CTAs, they just can't measure up and give institutions that sort of confidence. I think people who allocate money, they want to deal with firms that look like them and maybe even talk like them. But I'm a bad one to ask because we haven't really raised money in a long time other than through mutual funds. And I feel like our strategy, the way we talk to people, it seems to resonate better with the retail investor in a mutual fund. So to some degree, I'm guessing, but it's probably very logical. And it's also probably very discoverable. Ask people why they don't, large organizations and institutions and pensions don't give money to small traders. You'll probably get a pretty straightforward answer.
Yeah, but I agree, and but I actually think you are a great example, even though you say you're not, because you're right. I mean, when you've seen different sides of the cycle, it's some firms always seems to be going in one direction, right? So I think this is pretty valuable. What about you, Moritz? What is your opinion about this topic?
I believe good marketing is the secret sauce. If you just have a good track record, the best track record in the world, people aren't going to come to you. You have to do something on top of that. And when you look at the large firms, I mean, how did they become so large? I think they went out there and produced content, produced education. They've been very service-oriented, toward their investors. I think AQR, we can name them. They're a great example. You have Cliff Asness going out there with, papers on a regular basis, his opinions on a regular basis, and he makes the firm known, and they create a following. So it's about creating that following with, be that social media, publications, white papers, going to conferences, you name it. If you don't do that and all you have is that great track record, but nobody sees it, then it's going to be very hard.
Or even if people do see it, they're going to prefer maybe AQR, someone like AQR. So I agree with that totally.
Yes.
What perception? When I see you, your brand is what I think of you, what I believe about you when I think about you. And Cliff is perfect. He's really funny and he is really smart. And that's a great combination.
That's a very good combination. And then, once you've made it through that 1 billion AUM mark, or 2 or 3, or, multi-billion AUM mark, then you are that large firm with, maybe hundreds of employees, and they market their PhDs. And then if you don't have real bad performance that makes investors withdraw from your funds, and you've pretty much made it, then you're out there. But the real difficult thing is to move from 50 to 100 to 500 and maybe then to 1 billion. I think that is the real difficult part of the journey to become a large manager.
I mean, I agree with what you guys have said. I think, though, looking back at the last sort of 30 years or so, I think it all changed a bit with the financial crisis. I certainly feel that, back in the day, to some extent, you could get away with small organizations if you had good performance and so on and so forth. I think the financial crisis, to me, changed all of that, and it became this tick box mentality, and it became, advisor-driven, consultant-driven, where, if you weren't on their, approved list, you could forget about raising money from the big organizations. And of course, the firms who had made it at that stage, continue to raise money, and all the smaller ones have really struggled since. But I still think it's a really hard thing to do, raising capital. It's probably easy for a few firms because they have amazing track records and they have, great infrastructure and, good reputations and all of that. But I think most managers will say that it's one of the hardest things that they deal with. But I think it's true, and I think the other mistake I see from people, and that is not just that they're focusing too much on the returns in their marketing, but they're actually also trying to sell. And I don't think people want to be sold to. I think people want to be educated, they want to be motivated, and they want to know who they can trust. And it takes time. And unless you're really persistent about it and you're committed to deliver that value to your prospects and to your clients, I think that it's really tough to succeed in that part of the business. The funny thing, though, is, and maybe this is a topic for another conversation, and that is, once you then make it, money can flow in pretty quickly because you're now institutional grade, and you get into these big mandates and you get, big clips of assets. But then performance seems to, at some point, that's at least how I feel about it. I think a lot of managers overstep the capacity issue, and when it becomes size driven for whatever reason, and I think that's a shame, to be frank, because then investors get this bad feel about the industry we're in and saying, oh yeah, but the industry is not doing so well. They look at the index, and of course the index is dominated by the top 20 managers, right? So they are the index, and if they are all raising too much money and the returns deteriorate, then the whole industry gets a bad rap for that. So I think it's difficult to raise the money, and it's also difficult once you've raised them to apparently say no to more money because it's tempting to continue.
That's beautiful insight. Absolutely. There's so many pitfalls along the way, and some of them don't have anything to do with systems or proper trading, entries and exits. And it's like the world's waiting. If you misstep, the competition is so intense. There's always someone else. I would also add that it's once again probably a big topic for another discussion, but I think it's worth asking a hard, rude question, which is, do the CTAs, have they given people what they want? I think we continue to say over and over how we do things. And then our conclusion is, well, we have to educate people better. And I think that's probably a little silly in the sense that we're pretty good at educating and it's not that difficult. It's just that people don't like what we offer. And we're not sitting around going, what part of what we do can we craft into another type of vehicle or another type of product that they may actually want to buy? It is a business at the end of the day. I know I like to forget about that because this podcast is about theory and rules and philosophy and worldview. But why not mostly a stock portfolio? Mostly 50, 60, 70% individual single stocks with some currencies and commodities. So day one, I should have started that fund. And to be more in line with what it looks like people like, after the lost decade, stocks began to look like a trading market as well. And but it didn't hinder people. After a couple of years of a good bull market, people are back to loving equities again. CTAs don't trade equities. Really, most of them don't. They trade the indices, and then they look at crisis alpha or how we fit into a portfolio of traditional assets versus sort of creating that portfolio. Here's mostly stocks with a little bit of FX and commodities. Then we're faced with these questions. Does trend following work? Well, this one fund I have that's mostly stocks, and it works great because it's mostly stocks. And that's the thing that's been trending, long trends the best. So we kind of got ourselves in a box where we're sort of very rigid in what we deliver. Maybe clients want, okay, I'll take the trend following, but please do mostly stocks or only stocks. But most CTAs keep plugging away and saying, nope, you need to buy what I'm selling.
Yeah. I mean, it's funny you say that. I mean, I think it was Henry Ford who said that if you ask customers what they want, they would have told him at least, a faster horse. So I think what he was saying is that people don't really know what they want until you show it to them. And then I think Steve Jobs, kind of repeated that sometimes it takes someone to, not do what people want, but do something else and then demonstrate that it's good for them. And it's a great point you make, because I think we can prove, I mean, there's never been a white paper written that is, talks against the original Lindner paper that adding managed futures to a portfolio of stocks and bonds will increase returns and lower your drawdowns. There's never been a white paper to disagree with that, right? So I think we've got all the proof on our side that people should want what we are offering. But I agree with you as well, Jerry, that if we were packaging it differently to something more in terms of what they think they like, we would sell more of it, for sure. But is it really what they should? I mean, is it really what they should buy? Things from us that is more in line with what they already have to some extent. I don't know. I mean, let's keep that for another week, because we've already been going for almost an hour. We want to keep these conversations, but it shows, I think, hopefully the listeners, that there's going to be plenty of stuff coming from us in the time ahead. So I think if it's okay with you guys, we'll wrap up for this week. How do you feel about that?
I think we got a lot to talk about. So it's encouraging. I was wondering.
Yeah, and we should touch on that point again. Why don't investors always want to have trend following? I mean, look at 40, 50 years of trend following history, you look at the chart and you you must say to yourself, how can you not want that, right? But then you live in right here, right now in real time, and maybe it hasn't worked for 5 years. And then all of a sudden, your perception changes. If you compare performance to a strong bull market in the S&P 500, boom, there you go. You don't want that anymore. There's a lot of short-term thinking there going on, but let's make that another episode.
Sure. All right, cool. On that note, let's wrap up this week's conversation. We hope that you've enjoyed it just as much as we enjoyed making it for you. From Jerry, Moritz, and me, thanks so much for listening, and we look forward to being back with you next week.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.